Hello everyone. Today, we're going to be learning about restricted stock units, or RSUs, within your compensation package at ExxonMobil. My name is Kyle McClain, and I'm a partner and senior wealth manager with Rame and Gorell Wealth Management. ExxonMobil compensates high-performing employees with various forms of additional compensation above their base salary. Bonus compensation is available to certain employees, but the most common example of additional compensation at ExxonMobil is RSUs. So, what are RSUs? Restricted stock units are a form of ExxonMobil stock compensation that becomes available to you or vests over time. Unlike stock options, which give you the right to buy shares at a set price, RSUs don't require you to purchase anything. Once they vest, the shares are simply delivered to you. At ExxonMobil, RSUs are the most common form of bonus equity compensation awarded above your base salary, and they come with a handful of characteristics that open the door for tax planning. This can be a complex topic, so if you or someone you know could benefit from this information or the other services that our firm offers, please reach out for a complimentary consultation with our team, where we will take a look at your financial situation to determine opportunities for optimization from an employer benefits, executive compensation, investment, tax, estate, and retirement planning perspective. Before we go any further, let's define a few important terms. The grant date is the date that the restricted shares are awarded to you. It's the first event that takes place with your RSUs. The vest date is the date that the restriction lapses and the shares are delivered to you. The vesting schedule is the timeline over which you earn and receive those shares. And the cost basis, in simple terms, is the original value of an asset for tax purposes. For RSUs, the cost basis is determined by the value of the ExxonMobil stock on the vest date. The most important factor surrounding RSUs is that vesting schedule. So let's take a closer look. When you are awarded a grant of RSUs, the first 50% of the shares vests 3 years after the grant date. The other 50% vests 7 years after the grant date. This vesting schedule is designed to encourage retention and reward employees who stay with the company over the long term. There are 2 additional factors worth noting. First, if you leave ExxonMobil before your shares vest, you will generally forfeit them unless negotiated otherwise. Second, and this is a favorable one, if you retire from ExxonMobil while you still have unvested shares, those shares will continue to vest on the predetermined schedule into your retirement. Because grants are typically awarded over time, you may have several grants at different points along their 3-year and 7-year timelines all at once. Let's walk through a simple example. Meet Mark, an ExxonMobil employee who receives a grant of RSUs worth $200,000. Under ExxonMobil's schedule, half of that grant, or $100,000, vests 3 years after the grant date. The remaining $100,000 vests 7 years after. Now, let's say that the following year, Mark receives a second grant, also worth $200,000. That grant follows the same schedule, with $100,000 vesting 3 years after its grant date, and the other $100,000 vesting again 7 years after. Because the 2 grants were awarded a year apart, their vesting events are staggered. Mark's first grant delivers shares in 3 years and 7, while his second grant delivers shares in years 4 and 8. And as ExxonMobil keeps awarding these grants throughout Mark's career, these timelines layer on top of each other. So in any given year, he may have shares vesting from several different grants at once. Keep in mind that the actual value at each vest date will depend on where ExxonMobil's stock price is at that time, since the shares are delivered to you on the vest date, not the grant date. Now that we know how vesting works, let's take a look at the taxation, because this is where good planning really pays off. When you are first awarded your RSUs, no taxes are due at the grant date. The first taxable event takes place at the first vest date in year 3. At that point, the fair market value of the vested shares is included in your income for that year and taxed as ordinary income. That value also becomes your cost basis going forward. The same thing happens again at the second vest date in year 7. To cover the taxes, ExxonMobil automatically sells a portion of your vesting shares. For employees earning less than $1 million, they sell about 22% of the shares, and for those earning more than $1 million, they sell 37%. Here's something important to watch. That default withholding may not be enough to cover your full tax bill. If a large grant vests in a year that you're already earning a high salary, your total income could land you in a much higher bracket than the 22% withheld. In that case, it's wise to make what's called an estimated tax payment during the year so you're not caught off guard come tax filing season. This is something our team helps clients plan for proactively. After your shares vest, any future movement in the stock price creates a second potential tax event when you eventually sell. If you hold your shares for more than 1 year after vesting, any additional gain qualifies for the preferential long-term capital gains rates. Sell within that first year, and the gain is taxed as ordinary income instead. Let's put some quick numbers to it. Say $40,000 of Mark's vested shares later grow to $52,000. If he sells within a year of vesting, that $12,000 gain is taxed as ordinary income, which in a 32% bracket comes to $3,840. If he instead holds for more than a year and qualifies for long-term treatment, that same $12,000 gain might be taxed at 15%, or $1,800. Once your shares vest, the big question becomes whether to hold them or sell to diversify. Many ExxonMobil employees choose to sell their shares as soon as they vest in order to diversify. One nice advantage of that is because your cost basis equals the fair market value on the vest date, selling right away usually triggers little to no additional capital gain. This decision matters more than most people realize because holding a large amount of ExxonMobil stock introduces single stock concentration risk. In fact, many ExxonMobil employees already have a sizable portion of their wealth tied to the company in other ways, whether through low basis shares earmarked for net unrealized appreciation treatment, or through the ExxonMobil pension plan. For those folks, selling RSU shares at or near their cost basis as soon as they vest can be a prudent way to trim that concentration without much of a tax cost. And for anyone looking to reduce a larger concentrated position without triggering a big tax bill all at once, there are advanced strategies worth exploring, like direct indexing, which uses ongoing tax loss harvesting across many securities to help offset the gains created when trimming a concentrated position. As always, the right approach depends on your specific situation, your other income, and your long-term goals. So we'd encourage you to review these decisions with a qualified financial and tax professional, such as the ones on our team in-house. Thanks again for spending some time with us today to learn about restricted stock unit compensation at ExxonMobil. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management, and as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specialize in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life, both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.